Are you brand new to dividend investing and feeling completely overwhelmed by just how many different stocks and ETFs there are to pick from? When I first started dividend investing, I had no idea what I was doing. It took me countless hours of researching on the computer, looking at different YouTube videos, reading different articles, spinning my wheels, basically figuring out everything that I could soon forget because none of it was the right information. Don't worry if you're just getting started. It's really not as complicated as it seems. In fact, it's actually pretty simple once you narrow down what exactly it is that you're focusing on. If you follow these 7 dividend investing rules, you'll build yourself a portfolio that will set you on the path to financial freedom and pay you very, very well. But before we get started, welcome back to the channel where we discuss how to grow our portfolios for the ultimate portfolio payday. Just remember, I'm some random dude on the internet, so always make sure to do your own due diligence before you invest any of your hard-earned money in the markets. So let's get started. Rule number 1, avoid high yield traps. I'm sure you know which ones I'm talking about. Those stocks that have a 30, 40, 50, 60% dividend yield that pay you very, very well. It might look like a no-brainer because it's paying you lots of money, but high yields often reek of trouble. Stocks that pay that high of a yield typically have problems. Maybe the stock price is on the decline, maybe there's massive NAV erosion, or simply the payout is not sustainable over time. It definitely pays to do your own due diligence and know more about the company before jumping into such a high yield. I've definitely made the mistake as well as chasing these very high yields that pay a 40% dividend yield, but ultimately that stock price just continues to drop and go lower and lower. So ultimately you end up selling the stock and putting it into something that's going to be a little bit more sustainable over the long term. Now remember, some investments naturally pay higher yields and they're reputable ETFs or solid companies. Some of the higher dividend yields that I like to purchase and add to my portfolio would be business development companies like ARCC or CSWC, or the NEOS pair that everyone seems to love, which actually is a pretty good ETF to invest in. There's SPYI or QQQI. But even then, you want to dig a little deeper and do your research on those ETFs or those companies to make sure that they fit your portfolio. You want to make sure that it's not some fly-by-night company or one of those social media influencers that you might see on Instagram or TikTok that are promoting a stock, driving the price up, only to end up having it be kind of a crappy stock, a very inefficient stock in the long run. Rule number 2, be patient. Dividend investing is a long-term game. It's not something you're going to make money on overnight or in the next week or in the next month. You have to think decades, not weeks. Dividend investing is great if you have 10, 15, 20, 30 years out, but if you only have a couple months or 6 months, it's probably not where you want to park your money. Everyone wants that instant gratification, and ultimately they want to make money now versus seeing the long run and how much potential there actually is. You have to think about your portfolio like a house or a building where you pour the concrete foundation and you build it brick by brick over the long run. So essentially that house is going to have a solid foundation and a sturdy frame. You have to think about dividend investing like that. You really have to look at dividend investing as a very slow and boring process. The early days of investing feel super slow. And you really look at your account and wonder, am I really even making any money? But eventually that snowball effect will take place. You just have to be patient and keep believing in the process. Slow and steady wins the race, and that's where the real wealth is built. Rule number 3, understanding your taxes. Earning dividends and dividend income is not all taxed the same. It's very important to understand there are 2 different types of categories for dividend taxation. So this is definitely something you want to think about when adding stocks to your portfolio. You have to think about the taxes that you're going to be paying and which account you want to grow those dividends in. The first of the 2 different categories is called qualified dividends. These are taxed at a lower long-term investment rate. And in this category, investors typically pay taxes from 0 to 20% based on the income levels. As you can see here, look at which income levels you fall under and then the corresponding tax rate associated with it. The second category is called non-qualified or ordinary dividends, and this rate is taxed as ordinary income. As you can see here, it ranges from 10 to 37%. Looking at this chart, you can see a 37% tax rate is going to be for those in the top 1%. So take a look and see where you qualify at. Examples of an ordinary tax rate would be companies like REITs, like Vici or Realty Income. This is a big reason why many investors use Roth IRAs or tax advantaged accounts, because they want to make sure that if you do hold a REIT or a dividend that's taxed as ordinary income, you want to have it in a tax deferred or tax advantaged account so you can keep more of that money over the long run versus having to pay Uncle Sam more than you really want to and keeping more in your pocket. Rule number 4, stay afloat in rough seas. The nuances of the market will always change. It ebbs and it flows. The market will go up, the market will go down, it'll go up on bad news, it'll go down on good news. You just never know what it's going to do. But in these instances, you just want to stay the course. Don't freak out and sell your position because you think, oh, it's going to continue going down. Just trying to stay calm and let the market do what it's going to do is how you stay ahead in this game. If you bought a company because you like the fundamentals, you think it's got a great dividend yield, it's doing everything that you expected it to do, why would you sell it? There's no reason to. You just want to stay afloat and don't panic sell when things go bad. Think about when the market crashed during 2020 or when the market crashed a little bit in the last couple of years. People panic sold because they didn't know what was going to happen. And essentially that market recovered far better than what it dropped. So at the end of the day, if you're investing in a company because you believe in it, don't sell it. Just weather the storm, stay strong, and keep investing in it. Panic selling leads to losses, while downturns can be an amazing opportunity to invest in a stock. When there's blood in the streets, buy. Just something to remember. Rule number 5, always reinvest your dividends. This is something that I practice religiously because it's that much quicker that it's going to get me to my snowball effect. Reinvesting your dividends is the quickest and most powerful way to supercharge your portfolio and your income, continually reinvesting those dividends over time. When you reinvest your dividends and your account is set up to drip, you automatically buy more shares. Those new shares end up giving you more dividends, which buy more shares, which then make you more dividends, which those end up buying more shares. The process just repeats and repeats and repeats, buying more shares over time. That's the power of compounding. I'm personally starting to see that effect with some of my holdings such as SPYI or ARCC. Now let's take a look at this example here. If you invested $100 a week into SPYI for the next 20 years, you could potentially end up with $433,000 in your portfolio investment value and nearly $52,000 a year in annual dividend income. Now, if you didn't reinvest those dividends and you didn't have it set up to drip, your portfolio would be about $133,000 with far less income. This is exactly why you want to reinvest those dividends to keep building your portfolio for that snowball effect. Rule number 6, diversify your portfolio. I know it's pretty straightforward, but I don't want to skip this because it's extremely important that you diversify your portfolio because there's always the unknowns of the market. Never rely on just one company or one sector to hold you through to the end. Essentially, you want to spread your investments out over multiple sectors to mitigate any risk that you potentially could face. Realistically, only you know your risk, so it's up to you to decide how you want to allocate your portfolio. Some investors say no more than 5% per stock or ETF in their portfolio, while others swing for the fences. For me personally, I like to allocate no more than a certain percentage per stock or ETF in my portfolio. And I definitely like to diversify between REITs, BDCs, ETFs, tech stocks, banking, and other sectors. If this process sounds extremely overwhelming, you could really simplify the process and go with a couple different ETFs that will make you money and growth over the long haul without having to put too much emphasis or effort into it. You could pick a nice ETF where you can just set it and forget it. Think SCHD, SPYI, VOOO. Those are three right there that you could potentially get dividend income from and see opportunities for growth. You get instant diversification with these, and they're managed extremely well to give you maximum return. And we come to the last rule of mine, rule number 7, always consider your risk. You have to remember that dividend stocks are not risk-free. The stock market can be a complete gamble if you let it be. So you have to look at the big picture, understand the company, the sector exposure, understand the fundamentals, know what you're getting into. If the company has a history of cutting dividends, is that something you really want to invest in? Do they have products that fail? What happens to the stock if they do? Think the Jewel product in Altair Group a couple years ago that failed miserably, but yet it still pays a 6.8% dividend yield. I've been investing in Altair Group for years, and it's definitely something I've kept a close eye on. But as they continue to pay and increase their dividends, it's something I'm going to hold for the long term. However, if they end up cutting or changing some of the fundamentals or strategies they have, I might reconsider and look at what I'm going to do with the stock. At the end of the day, you always have to do your due diligence to know if that stock or ETF will have a place in your portfolio for the long run. Look at the yield, look at the payout ratio, look at the company debt, look at the exposure of the sector. This all will paint a picture for you to understand your risk. So in the end, a well-diversified, carefully chosen portfolio is your best defense against sudden dividend cuts or a failing company. So just remember, if you're new to dividend investing, incorporate these 7 dividend investing rules into your portfolio. Essentially, you'll end up building a very nice portfolio that will pay you income for years to come. Drop me a comment below and let me know if you've started building a dividend portfolio. And if you haven't, what's holding you back? Also, if you're interested in learning why I invest in SPYI, take a look at the link in the description below. Until the next time, have a great one.